This lecture will cover financial statement analysis. Some of the items we are going to review today include performing vertical analysis, horizontal analysis, using ratios to analyze a company's risk, and then using ratios to analyze the profitability of a company. We'll distinguish persistent earnings from one-time items, and then we'll talk about conservative and aggressive accounting practices. Now in this section, we're going to look at how we can use ratios to help evaluate a firm's performance and financial position. Ratios are most often beneficial when compared to some type of standard. So that standard of comparison may be the performance of a competing company, or could be last year's performance by the same company, or it could also be an average performance of companies of a similar industry. Now this slide provides a summary of three different types of comparisons between companies over time and industry comparisons. Let's take a look at vertical analysis. In performing vertical analysis, we express each item in a financial statement as a percentage of the same base amount. So for instance, we can express each item as an income in the income statement as a percentage of sales. Or in the balance sheet, we can express each item as a percentage of total assets. Let's take a look at an example to see the benefits of vertical analysis. So this slide provides common size income statements for Under Armour and Nike. Notice that the two companies end their fiscal year on different dates. Even though the year ends do not exactly match, we can still make some meaningful comparisons between the two companies. So in this example, Nike reports net income of $2.7 billion, while Under Armour reports only $208 million. We must keep in mind that Nike's a lot bigger company, reporting sales over $27 billion compared to $3 billion for Under Armour. Because of its greater size, we would expect Nike to report a greater amount of net income. To better compare the performance of the two companies, we can use vertical analysis to express each income statement item as a percentage of sales. Now, Under Armour's gross profit is 49% of sales, which is going to be the $1,512. Divide that by $3,084. So the gross profit divided by the net sales is going to equal 49%. But Nike's is 44.8%. Now this means Under Armour earns a slightly higher gross profit for each dollar of sales, consistent with its business strategy of focusing on high-quality performance apparel. However, Under Armour's higher gross profit gets offset by its proportionately higher operating expenses, 37.5% of sales compared to 31.5% for Nike. The net results that operating income as a percentage of sales is slightly lower for Under Armour. As you see there, net income or operating income is 11.5% for Under Armour. Nike is 13.3%. Finally, Nike's net income as a percentage of sales exceeds Under Armour's by about 3%. You see that Under Armour is 6.7% net income and Nike is 9.7%. So it's explained by Nike's slightly better operating income as a percentage of sales, and it appears Nike has a lower portion of income reduced for income tax purposes. Vertical analysis on the balance sheet's pretty useful. So for this, we divide each balance sheet item by total assets to get an idea of its relevant significance. This slide provides common-sized balance sheets for Under Armour and Nike. Now, focusing on the asset portion of the balance sheet, we discovered that Under Armour has a higher percentage of intangible assets than Nike and a slightly lower share of assets invested in property and equipment, where Nike has a higher percentage of other assets. If we look at liabilities and stockholders' equity, we see that Nike has a slightly higher portion of current liabilities. Nike's higher current liabilities will result in less favorable current ratio and acid test ratio. Both companies maintain similar proportions of long-term liabilities of 15.4% and 14.8%, as you see there, and are financed to a much greater extent by equity than it is by debt. It's also interesting to see that the relative contributions of common stock and retained earnings for the two companies. So for Under Armour, the balance of retained earnings exceeds the balance in common stock, indicating the profits retained in the company exceed the amounts originally invested in the company. Now, for Nike, the balance in common stock exceeds the balance in retained earnings, which shows the amounts invested by shareholders exceed the profits that have been retained. A key point to remember as we move on, with vertical analysis, we express each item as a percentage of the same base amount, such as a percentage of sales in the income statement or as a percent of total assets in the balance sheet. Let's look at exercise 12.2. So the income statement for Federer Sports Apparel for both 2019 and 18 are shown here below. So in 2019, we've got net income of $850,000, and in 2018, we have net income of $4 million. If you look at the detail, you do see an inventory write-down and a loss due to litigation in 2019. We're supposed to prepare a vertical analysis for 2019 and for 2018. So basically what we've done here is we take the income statements and we are going to base everything on net sales. So as you see here, this $18,800,000 is at 100%. It's the same with the 2018 $15,500,000. Our cost of goods sold is at 70.2% of net sales. We would get that by taking the $13,200,000 and dividing it by $18,800,000. Gross profit's then done the same way. So the gross profit of $5,600,000, divide that by $18,800,000, gives us the 29.8%. You see, in 2018, the gross profit margin was much higher than it was in 2019. As you keep going down to all the various items, in 2018, our income before taxes were at 38.7%, and in 2019, it was at 6.9%. So take some time to look at this so you understand exactly how vertical analysis works. When using vertical analysis, we express income statement items as a percentage of what? We just looked at that. I hope you get it. Each item in the income statement is expressed as a percentage of sales. Next, when using vertical analysis, we express balance sheet items as a percentage of what? Total assets. Now let's look at performing horizontal analysis. We use horizontal analysis to analyze trends in financial statement data for a single company over time. With horizontal analysis, we calculate the amount and percentage change in an account from last year to this year. This data can then be used to compare rates of change across accounts. Are sales growing faster than cost of goods sold? Are operating expenses growing faster than sales? Are any specific expenses increasing at a greater rate than others? Questions such as these can identify areas of concern or perhaps indication of better things to come. So this slide provides income statements over 2 years for Under Armour. The final 2 columns show the dollar amount and percentage changes. We calculate the amount of the increase or decrease by simply subtracting the 2013 balance from the 2014 balance. The positive difference indicates the amounts increased in 2014. A negative amount represents a decrease, which we record in parentheses. We calculate the percentage increase or decrease based on the formula shown on the previous slide. So for example, the amount of sales increased $752 million, which is equal to sales of $3,084,000 in 2014 minus sales of $2,332,000 in 2013. We calculate the percentage increase of 32.2% by dividing the $752 million increase in sales by 2013 sales of $2,332,000. If the base year amount of 2013 in our example is ever 0, we can't calculate a percent for that item. Now, the horizontal analysis of Under Armour's income statement demonstrates strong, steady growth in company operations. Gross profit increased 33%, or 375 divided by 1,137. Operating income increased by 33.6%, which is the $89 divided by 265. Income before tax increased by 31%, which is the $81 divided by the 261, and then net income increased 28.4%, which is the $46 divided by the $162. Now the growth in these income measures is pretty impressive. Now this slide provides balance sheet information for Under Armour in 2014 and 13 with amounts and percentage changes in the final 2 columns. So the horizontal analysis of Under Armour's balance sheet reflects its growth in operations during the year. Each of the categories increased with the exception of a slight decrease in current liabilities. Besides reinvesting profits in the company, Under Armour is funding its growth with both long-term debt and issuing additional shares. Long-term liabilities increased by $226 million, and Under Armour had a stock offering again in 2014, as reflected in the $93 million increase in common stock. Retained earnings increased $203 million, or 31%, due primarily to net income of $208 million during the year, as shown what was on that previous slide there. Now, a key point to remember when using horizontal analysis is that it analyzes trends in financial statement data, such as the amount of change or the percent of change for one company over a period of time. Let's perform the horizontal analysis. So we've got the Federer Sports Apparel for net income of 2018 and 2019. So as you see here, we will take the 2019 figures, subtract the 2018 to come up with a positive number, meaning that 2019 increased over 2018, or if it's a negative number, there was a decrease. So what we do is we take the the difference in revenues is $3,300,000, and then from there we're going to divide that number, the $3,300,000 divided by the $15,500,000 to give us a percent of 21%. The same is true with each one of these items. We are going to cost of goods sold. The increase is $6,200,000. We take the $6,200,000 divided by the $7 million, the 2018 figures, gives us an increase of 88.6%. Now, inventory write-down, we can't create a percent because 1 year is 0. The horizontal analysis examines trends. Is it A, between companies, B, between balance sheet accounts in the same year, C, for a single company over time, or D, as a percentage of sales on every financial statement? Hope you got that. We use horizontal analysis to analyze trends in financial statement data for a single company over time. With horizontal analysis, we calculate the amount and percentage change in an account from last year to this year. Now in this section, we're going to review 14 ratios classified into 2 categories: risk ratios and profitability ratios. When calculating ratios, remember how income statement accounts differ from balance sheet accounts. We measure income statement accounts over a period of time, and we measure balance sheet accounts at a point in time. So remember, income statement items are over a period of time, like a video is. Balance sheet accounts are at a point in time, like a picture, a photograph. So ratios that compare an income statement account with a balance sheet account should express the balance sheet account as an average of the beginning and of the ending balances. So let's talk about using ratios to analyze a company's risk. Now, a common mistake in using the ending balance in a ratio as opposed to the average of its beginning and ending balances. Income statement accounts are measured over a period of time, like a video. Balance sheet items are just measured at a point in time, like a snapshot. So to review each ratio, we're going to be referring to this 2014 income statement for Under Armour in order to come up with our analysis. We're also going to be referring to these balance sheets for Under Armour in our ratio analysis. So, some of the ratios we are going to look at are shown on this slide. We're going to go over each one of these ratios individually in this lecture. We divide the 8 risk ratios into 6 liquidity ratios and 2 solvency ratios. Liquidity refers to how much sufficient cash or other assets are able to be converted readily into cash to pay its current liabilities. The accounts used to calculate liquidity ratios are located in the current assets and current liabilities section of the balance sheet. Solvency refers to the company's ability to pay its long-term liabilities as well. Now, the receivables turnover ratio measures how many times, on average, a company collects its receivables during the year. A low receivables turnover ratio may indicate that the company is having trouble collecting its accounts receivable. A high receivables turnover ratio is a positive sign that a company can quickly turn its receivables into cash. Now, this slide shows the calculation of the receivables turnover ratio for Under Armour and compares it to Nike's. In calculating the receivables turnover ratio, we've assumed that Under Armour's sales are all credit sales. The bottom half of the fraction is the average accounts receivable during the year, calculated as beginning receivables plus ending receivables divided by 2. Under Armour's receivables turnover is 10.6. That indicates that receivables turnover that are collected are 10.6 times per year. This is much higher than Nike's receivable turnover of 7.7 times. Now, we often convert the receivables turnover ratio into days and call it the average collection period. The shorter the average period, the better. So this slide shows the average collection period for Under Armour and for Nike. The Under Armour's average collection period is 34.4 days, which is the 365 days in a year divided by the receivables turnover ratio of 10.6. It takes Under Armour an average of over a month to collect its accounts receivable. Nike's average collection period is 47.4 days, almost 2 weeks longer. Now, the inventory turnover ratio measures how many times on average a company sells its entire inventory during the year. A high inventory turnover ratio usually is a good sign. It indicates that the inventory is selling quickly. Less cash gets tied up in inventory and the risk of outdated inventory is much lower. However, an extremely high inventory turnover ratio could be a sign the company's losing sales due to inventory shortages. So this slide here shows the inventory turnover ratios for Under Armour and Nike. Inventory at Under Armour turns over on average about 3.1 times per year compared to Nike of 4.1 times a year. The slower inventory turnover at Under Armour isn't a good sign. It's negative, indicating a greater risk of slow-moving inventory items. We can convert the inventory turnover ratio into days and call it average days in inventory. So, as you imagine, companies try to minimize the number of days they hold inventory. We calculate the average days in inventory in this slide. You see Under Armour's average days in inventory is 117.7 days. We calculate it by number of days in a year, 365, divided by the turnover ratio of 3.1. In comparison, Nike's average in inventory is a lot lower at just 89 days. Now, the current ratio compares current assets to current liabilities. It's probably the most widely used of all these liquidity ratios. A high current ratio indicates a company has sufficient current assets to pay current liabilities when they come due. This slide presents the current ratio for Under Armour and Nike. Under Armour's current ratio is 3.7, which means the firm has $3.70 in current assets for every $1 in current liabilities. Now, Under Armour's current ratio is a lot higher than Nike's of 2.7. A company needs to maintain sufficient current assets to pay current liabilities as they come due, but a higher current ratio usually indicates less risk. However, a higher current ratio isn't always a good sign. A high current ratio might occur when a company has difficulty collecting receivables or carries too much inventory. Analysts become concerned if a company reports an increasing current ratio with either a lower receivables turnover ratio or a lower inventory turnover ratio. Now, another liquidity is the asset test ratio. It's similar to the current ratio, but it's much more conservative measurement of current assets available to pay current liabilities. Specifically, the top half of the fraction includes only cash, current investments, and accounts receivable. Remember, with the current ratio, it includes all current assets. Because it eliminates current assets such as inventories and prepaid expenses that are less readily convertible into cash, the asset test ratio often provides a better indication of a company's liquidity than does the current ratio. This slide presents the asset test ratios for Under Armour and Nike. Under Armour's asset test ratio is 2.2 to 1, compares favorably with Nike's of 1.8 to 1. Both companies appear to have more than enough liquid assets to pay current liabilities as they come due. The first 6 ratios relate to liquidity, or a company's ability to pay its current liabilities. Now these 2 relate to solvency, or a company's ability to pay its long-term liabilities as well. Other things being equal, the higher the debt-to-equity ratio, the higher the risk of bankruptcy. The reason is that unlike shareholders, debt holders have the ability to force a company into bankruptcy for failing to pay interest or repay the debt in a timely manner. So this slide shows the debt-to-equity ratio for Under Armour and Nike. Under Armour has a debt-to-equity ratio of 55.2%, or about 55 cents in liabilities for each dollar in stockholders' equity. Nike's debt-to-equity ratio is higher at 71.8%. Additional debt can be good for investors as long as a company earns a return on borrowed funds in excess of the interest costs. However, taking on additional debt can also be a bad thing for investors if interest costs exceed the company's return on borrowed funds. This highlights the risk-return trade-off of debt. More debt increases the risk of bankruptcy, but it also increases the potential returns investors can enjoy. Now, we use times interest earned ratio to compare interest payments with the company's income available to pay those charges. Interest payments are more often associated with long-term liabilities than with current liabilities, such as wages, taxes, and utilities. We calculate the times interest earned ratio by dividing net income before interest expense and income taxes by interest expense. To get this amount, we just add interest expense and tax expense back to net income. We use net income before interest expense and income taxes as a reliable indicator of the amount available to pay interest. So this slide shows the times interest earned ratio for Under Armour and Nike. Under Armour's interest expense of $5 million is not listed separately on the income statement, but rather is obtained from the notes to the financial statements. The times interest earned ratio for Under Armour is 69.4 times. That means Under Armour's net income before interest and taxes was 69.4 times the amount it needed for interest expense just alone. But in comparison, Nike has an even better times interest earned ratio of 108.4. So both Under Armour and Nike generate more than enough income to cover their interest payments. A key point to remember: we categorize risk ratios into liquidity and solvency ratios. Liquidity ratios focus on the company's ability to pay current liabilities, while solvency ratios focus more on long-term liabilities.